Hi folks, and welcome back to our 2024 YouTube mentorship. I believe you're enjoying the mentorship. Today I want us to look at a very critical perspective, that is how to do a top-down market analysis. And this is the question I've been receiving privately from most of traders that I've interacted with. And the reason why I felt it's good to do a common video whereby I'll give you insights on how to be able to do a top-down market analysis. So key concept covered here is one, what is top-down market analysis? The importance of doing a top-down market analysis, reasons for multiple time frames, how to identify key levels, and also we shall look at practical examples of top-down analysis from the market. When you talk about top-down market analysis, this is an approach that entails analyzing the market from a higher time frame to a lower time frame to better understand the market conditions. So basically, top-down analysis is used in the financial market, including the foreign exchange market, to access the overall market condition and help in making informed trading decisions. It involves analyzing the market from broader perspective before narrowing down to specific details. For example, from monthly time frame to 15 minutes time frame. So you can begin from, let's say, a monthly time frame, and then you go all the way to 15 minutes time frame, probably being the time frame that you take your trades from. That is where you take your entries. So up to which time frame that you'll do the top-down analysis depends on the type of trader you are. So if you're a scalper, definitely you'll want to do analysis from their time frame all the way maybe to the 15 minutes time frame or 5 minutes time frame. If you are a swing trader, you want to do your top-down analysis from the higher time frame, let's say monthly time frame. You go all the way to weekly time frame, daily time frame, and probably maybe the 4-hour time frame. So mostly it is always recommended to look at 3 time frames above your trading time frame. Let's say you trade from the 4-hour time frame, so it's good to look at the daily time frame, you look at the weekly time frame, and you look at the monthly time frame. Why is it important for traders to do a top-down market analysis? Number one, top-down market analysis will help you in terms of what we call holistic understanding. By holistic understanding, we mean that a top-down approach allows traders to view the market, the Forex market from a holistic perspective, considering various factors that can be able to influence the currency movement. This includes global economic condition, country-specific fundamentals, and also the market sentiments. The other reason why a top-down market analysis is important is in the perspective of contextual decision making. So when you do a top-down market analysis, it enhances a trader's ability to make decisions. So traders who conduct a thorough top-down analysis are better equipped to make informed decisions. They have a more comprehensive understanding of the market, which can lead to better entry and exit points, as well as improved trade timing. The other key reason is to identify the market trends. So you find that when you're doing a top-down analysis, basically you want to know which is the trend of the market, or in which program are we in. Is it a buy program or is it a sell program? So again, analyzing the market from a top-down perspective will give us that understanding of which direction we shall be looking at, or maybe the daily bias, or maybe the weekly bias, or the monthly bias, such that once we understand the market trends, then we will be in a position to take what I call high probability trade. So the other reason is risk management, definitely. So understanding the broader market conditions help in improving or implementing effective risk management strategies. So by identifying key support and resistance levels and accessing the overall market sentiments, traders can set appropriate stop loss levels and manage their risk more efficiently. The other reason is long-term investment decisions. When it comes to long-term trade planning, for investors and position traders, a top-down approach is essential for long-term planning. So understanding the microeconomic environment and the fundamental trends helps in making strategic decisions that align with broader market movement. And the final reason why we do a top-down analysis, or why it's important to do a top-down analysis, is for the purpose of adaptability to changing conditions. You need to understand that the Forex markets are dynamic and can be influenced by various factors. So doing a top-down analysis allows traders to adapt to changing market conditions by staying updated on economic events, geopolitical developments, and shift in investors' sentiments. Okay. So it becomes quite imperative for a trader to understand this importance of top-down analysis, because it will help a great deal in terms of making decisions. So when we are doing top-down analysis, basically we use multiple time frames. And you might ask the reason why we use different or multiple time frames. So the first reason is because by using multiple time frames, this helps traders to overcome confusions regarding the market direction and trend. So that means once you have done a top-down analysis using different time frames, these will wipe out the confusions in terms of the market direction or the market trend, because we use the higher time frame, let's say the weekly, the monthly or weekly or daily, in order to get the direction or the overall direction of the market. Therefore, if you are trading from the 1 hour time frame, we will know that maybe we are bullish, and in case the retracement, the market is maybe bearish in the 1 hour time frame, at the back of our mind, maybe that will linger as a retracement. So it helps also traders to increase trade accuracy, because you are able now to narrow down the market, okay, and arrive to a specific maybe a point of confluence or point of interest, and this helps in terms of increasing trade accuracy. And the last reason is because it helps identify high probability entries and exit points. So once you do the top-down analysis, you mark your key levels, you identify the market direction, and also you look at maybe the liquidity zones, or maybe the supply and demand areas. It means that by the time you are taking your entries, these entries are what we call high probability entries, because they align according to the market, and probably that is where the point of confluence is. When you talk about the point of confluence, this is where we have more than two reasons aligning together at that point, giving you the opportunity maybe to make a decision on whether to buy, or maybe to exit, or maybe to sell the market. When you're talking about multiple time frames, you need to understand that basically I like categorizing them into three. So the higher time frames, I consider them to be the monthly, the weekly, and the daily time frame, and I use them to identify key levels. Then we have the H1 and the H4 time frame, that is the 4 hour time frame and the 1 hour time frame, which are the analysis time frames. By analysis, these are the time frames, I mean that these are the time frames that we go to look at the market direction. We also want to look at maybe liquidity areas where we have maybe buy side liquidity or sell side liquidity, and these are the time frames that I like looking for trading opportunities. Then I go to the lower time frames, that is the M30 or the 30 minutes time frame, the 15 minutes time frame, and also the 5 minutes time frame, for which I use as entry time frame. So this is where I take my trades from. So I use them for confirmation and entry. So the reason why it is always important to do a top-down analysis, we said that it will help you in terms of identifying key levels. So I have said in the higher time frames, that is the monthly time frame, the weekly time frame, and the daily time frame, that's where I go to identify the key levels. So I want to draw the levels with many number of touches. I also want to consider levels near the current price. Also, you need to draw up the bodies of the candles, depending now on the type of structure that you have in the market. I'll be able to show you different examples. And also, you need to treat these levels as areas or zones and not single prices. I have always emphasized on that, especially when you are drawing supports and resistance. These are not single prices, but these are levels or zones. Okay, so now I want us to go to the market, and so that we can be able to look at different examples on how to do a top-down analysis. Folks, this is GBP JPY market. So we said that we begin when you're doing a top-down analysis, we begin from the monthly time frame. So this is the monthly time frame, and the first thing that we need to understand, or the first thing that we need to do, is to draw these levels, to identify levels. And we want to identify levels with, we said the levels that are of the greatest, maybe many touches. And also we want to look at the levels that are current near the price. Okay, so when we look at this market, basically what we have here, this is an uptrend market. Okay, this is an uptrend market. This is where we had a break of structure. I taught how to understand the break of structure. Go and check my previous video that I uploaded on how to check or to identify when you have a market structure change or shift. So here we have been in an uptrend. Okay, we have been in an uptrend. This has been a very nice uptrend. So the key levels that we can mark or that we can identify here, we have that key level. Okay, that is the key level that is near the price, and also this is the other key level that is near the price, whereby we have like series, we have some equal lows. Okay, or what we call the sell side liquidity above this level that is above here. This is what we call the buy side liquidity. So we go to the weekly time frame and we try to adjust those levels accordingly. So from the weekly time frame, that's what we have. The levels align accordingly from the weekly time frame. So we can even adjust this to this level, and then we can mark this one as the equal lows. So we go to daily time frame. We try to identify some key levels that we'll be able to see there from the daily time frame. So from the daily time frame, before the market pushes downwards to take out these equal lows all to this level, we first of all want to see the market come all the way to that level. So that's a key level again on the daily time frame. Okay, so this is a key level of support. And if we can be able to draw, it's actually a zone. Okay, this is actually a zone, because you can see at this area it acted as resistance. So once in this other level, we have this breakout. So we anticipate this market at this point to behave or to act as support. So on the downside, if the market comes on the downside, then we anticipate this level to be taken out first. And then on the upside, since we have a breakout, then it means that we might be anticipating the market to push on the upside direction. And this is the level that we shall be looking at. So if we go to the 4-hour time frame, I said from the 4-hour time frame, this is whereby we identify the market direction. We also identify maybe key areas of support and resistance. We also identify liquidity zones, and we look for trading opportunities. So from this level, we can identify that the market direction is bullish. Okay, we can identify clearly that the market direction is bullish. So this is where we had the break of the change of structure. So from this downtrend, so now we are in an uptrend. So the market pushed up, and you can see, like I said, this is a very key level. This is a very key level, a level of this side it's resistant, and now resistant is becoming what? Support. So because of this breakout, we anticipate the market to do a retest to that level, and then maybe if the bullishness continues, we anticipate the market to push on the upside direction. So having said that, the key level that we might be looking at on the upside direction, okay, so once the market maybe pushes downwards, the key level that we shall be looking at is actually this point, because this is a key level of resistance again, because you can see from this direction from all the way to this side, this becomes a key level of resistance, and we want to see how the price behaves at this particular level. So we might anticipate a push downwards, all then to test this area of support, okay, to test this area of support because of the breakout, and then now we might maybe see the price push upwards, or even the price can push upwards, break above through that point, and then if it breaks above that point, the next key area that we will be looking at from the 4-hour time frame, we want to look at this area here, then before we reach the ultimate decision, because again at this level we have a very key area. Okay, we have a key area at this level. Actually, from this level, we have what we call an order block. Okay, we have an order block. So that's an order block. Okay, so I'll be teaching about order blocks, so don't worry. But that's an order block. So we said again from this maybe 4-hour and 1-hour time frame, this is where we want to look for trading opportunities. And if now, because this is the area of support, okay, this side is support. If the market is able to retrace, then we have a demand area around that point. We have a demand area around that point, or we can call it a bullish order block, because this is what push the price upwards to break above that level, to create this break of structure. So it becomes high probability demand area or high probability supply area. So what I'm saying is that the market can come all the way to, can retrace all the way to that level, and then it means that that key level is very important, and we will be looking for price maybe to push all the way to that particular area. So that gives you a risk to reward ratio of 3:2. So we can look at what we have on the 1-hour time frame. And from the 1-hour time frame, it's an uptrend again, a very strong uptrend. So the 4-hour, the areas that we looked from the 4-hour time frame, they also align with the 1-hour time frame. So we want to see the market push maybe downwards, maybe to this particular level, and then we want to see the upward movement. So we use the 15 minutes time frame, the 30 minutes time frame, or the 5 minutes time frame for our entries. So we can go to the 15 minutes time frame. So from the 15 minutes time frame, we can be able to narrow down our risk. From the 30 minutes time frame, you can see we can be able to narrow our risk. So because this is our entry level from the 4-hour time frame, and from the 15 minutes time frame, we have a key area here. So we have that demand zone, or what we call a bullish engulfing, which becomes high probability. And also this is what we call a bullish a demand zone. Okay, it's a demand zone because you can see the price pushed out of that region with a lot of strength, and also it is this area of this movement that led to the break of structure. Okay, it led to the change of structure at that particular point. So now from the 15 minutes time frame, we can narrow down our risk and anticipate maybe to take our entries at that level where we have the 15 minutes time frame. Okay, where we have the 15 minutes demand area, and you can see now even our risk reduces, and now our risk to reward ratio becomes 5:1. Let's look at another example. This is a Euro GBP. So from the monthly time frame, what we have in Euro GBP, this pair is actually very choppy. So you can see from the monthly time frame, all we have, this is the market is consolidating. Okay, the market is consolidating within that particular level. Okay, that is consolidation. But we want to identify now the key levels from this area of consolidation, so that we can be able to use these levels even in the lower time frame. So I want to have that particular level at that point, and also we have another key level here. Okay, we have another key level here. Remember, we said these are just zones and not exact numbers. So we can use these to show. We can use rectangles to show that indeed these are zones and not just exact numbers. Okay, so that is a very key. Those are key levels from the monthly time frame. So we go to the weekly time frame. And from the weekly time frame, these levels again, they hold as well. You can see the market has been consolidating actually since September 2016. Euro GBP JPY has been consolidating on the higher time frame. That is the monthly time frame and the weekly time frame. So we have the daily time frame. We can go now. We can go to the daily time frame, and from the daily time frame, basically now we can be able to narrow the market, and we have this area that we want to look at. So this becomes very critical. It's a very critical area, like you can see. But also in terms of support and resistance, we want to look at this level. Okay, we want to look at that level. So this is a very key level of support and resistance, and we can actually mark at it from this particular point. Okay, so this becomes actually an area or a zone of support. Okay, it's a zone of support. So what we have from the monthly, from the daily time frame, is that if the price continues pushing on the downside, then we want to see the price come along all the way to this area of support, and then we want to see how the price reacts from that level. If the price is able to break below this level of support, then we will anticipate the price to come and test again the lower level of support. On the upside, what we have on the upside, this is a very key area as well. You can see from that point, that's a very key area of resistance. So if the price is able to push on the upside, we want to see how the price will react once it reaches this area of resistance. Maybe we will have the price retrace on the downside, or maybe we will have a breakout. Remember, the trader's mindset is always thinking in probabilities. We want to look at the both sides of the coin. So when you go to the 4-hour time frame, this is where we begin looking at the direction of the market, and also we begin maybe identifying areas of supply and demand. We also look at the liquidity zones, and also we try to look at trading opportunities. So from the 4-hour time frame, we can see clearly it's a downtrend. This is where we had the break of structure at that level. That's when we had the break of structure, and since then the market has been on the downside. Okay, since then the market has been on the downside. So from where the market is at the moment, I want to see the market push all the way maybe to that level first before coming down to this particular level. So if it comes to that particular level, when I want to take my trade now from this support level, I'll be looking at maybe these demand areas. That's where we have that bullish engulfing. So, and you can see this demand area is high probability because this is what led to this breakout of BOS here, and also that's what led to this abrupt movement of price. You can see there is a strong buy candle emerging from that particular level. So I'll be looking maybe probably for an entry around that point, and I will have my stop loss around that level. So I can be targeting maybe probably these buy side liquidities. Okay, so here we have buy side liquidities, all these equal highs. Okay, these equal highs. So I'll anticipate the price now to push upwards, aiming to take out these equal highs. So if we go to the 1-hour time frame, from the 1-hour time frame, what we have is the movement it's a continuation of the downtrend again. So this is just an internal structure. Remember, I taught about the market structure. You need to know the external market structure and the internal market structure. So this is the major high and this was the major low. So right now the market is trading within an internal structure. So from this level, what we have, the market, if the market maybe pushes slightly on the upside, then I would want to look for my entries around that particular region. Okay, I would want to look for my sell entries around that particular position, and maybe write the price down all the way to this level. Remember, I said as traders, we think in terms of probabilities. So if it gives us that kind of scenario, then that's the entry that I want to have at that particular level, targeting this liquidity level around that particular region. Okay, so I'll be targeting this liquidity level, even as the price now comes on the downside, maybe to activate our buy, so that we can be looking for the buying program. So if we go maybe to the 30 minutes time frame, let's see what we have from the 30 minutes time frame. So from the 30 minutes time frame, again, these rhyme so well. So you can see we have what we call an order block at that particular level. So we can even trim down our risk slightly. So you can see, you can be able to reduce our risk significantly. On the downside, from the 4 hour time frame, remember, this is our entry. So what we have maybe at this level, so what we want to do is to try and lower the risk possible. Okay, so from that level, from the 30 minutes time frame, then we can anticipate maybe the market even to push all the way downwards to this particular level, because this is where we have an order block or a demand zone. So because this demand zone, it's what led to the breakout of structure, and you can see consecutive buy candles erupting from that particular level. So if we go back to our entry here, so we can be able now to narrow down the risk and ensure that we have a high probability entry. So from this level, if you are taking a trade from that level, remember the risk to reward ratio is 3.881 is to 1 is to 3.88. But if we narrow down here now, we reduce our risk, and this gives us a risk to reward ratio of 1 is to 7.6. This means that we are risking $1 to make $7, right? So that's how you do a top-down analysis. And we said the reasons for top-down analysis, number one is to optimize trade entries, or to have high probability trade entries, and also to increase the accuracy of the trade, as well as to minimize the risk. So what I would want you to do is to practice doing this top-down analysis. I have been supporting you in terms of doing market analysis. That's the weekly market analysis that I always post on Sundays. But I would encourage you to do your own top-down analysis. And then once I upload my top-down analysis or my weekly market analysis, you try to see whether you are seeing what I'm seeing. Okay, that does not mean that I will be always right. Remember, there is no one who is always right. You can never corner the market 100%. But again, it helps you in terms of improving your confidentiality. If you look at what different peoples are doing, you'll be able to learn from them 1 or 2 things that will be able to increase or to help you improve your trading strategies. So until the next video, stay safe and keep always learning.